The following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Welcome to the Common Sense Investing show. I'm Victor McClure. I'm your host and the president of the Dillon Gage Wealth Management Companies. My co-host, Guy Allard, how are you?
Pretty good. Are we preempting UT this week?
That's right. Well, I talked to the president of CBS and of UT and told them no more taking our show.
No more football.
And they said, Mr. McClure, no problem, just for you.
Yeah, that's right.
You don't believe that one?
No, it's good to be back. Did any of you out there miss us the last 2 weeks?
A client just called me this week and said, "What, did you lose your radio show?" I go, "No, UT preempted it." It takes a long time. Everybody had to see them lose 2 times in a row, I guess.
I got a quick idea about our presidential race.
What's that?
I've heard people say if Hillary gets elected, they're moving out of the country.
Mm-hmm.
I've heard people say if Donald gets elected, they're moving out of the country.
Yep.
How about we just deport them and we stay?
That might be good.
Let's deport them.
Be careful. People get crazy on politics.
So,
we'll get a bunch of hate mail.
Well, now I like one of the presidential nominees' politics or policies, I should say.
This is the craziest thing I've ever seen.
Ugh.
Even the NFL, which is the holy grail of the United States, is down 16%. Everything is weird because everybody goes, "I don't know. I want it to be over.
Yeah,
just be over. I don't have to worry about this crap anymore."
Absolutely.
Unfortunately, like I said, I think my taxes are going up. I don't want it to happen, but
4 more weeks.
We're going to find out real soon.
Oh.
We've talked about finances, retirement. We do specialize in retirement because it's such a big need out there. Most advisors talk about growth of your money, and this is what you do with a properly diversified portfolio. It's all geared towards growth, and none of it's geared towards the other part of your life, which is when you start spending your money, you don't have an income coming in anymore and all that. And so we do spend a lot of time on that, but we also, like I said, we've done stocks for 30 years. We've always done stocks.
Done venture capital for years.
There's nothing wrong with the stock market. It's just a lot of people out there don't want the risk of the market, or they want some kind of safeguards in it. So even with our stock market stuff, it's going to be a little more conservative than others. I don't want to make it all, lose it all, and I can't stand losing 50%. It will not happen. I can't stand it. I can't look a person in the face saying, "Oh, by the way, you lost 50%. Stay the course. Don't get out."
And keep in mind when you're interviewing an advisor or you're talking with your current advisor and you're trying to get things squared away for your retirement. Retirement, even more so nowadays, is a very fluid situation. You've got the College of Financial Planners. You've got some good guidelines. We may get into some CPA certification later, some interesting things that they have to learn. But the rules have changed. For the last 14 or 15 years, the S&P with dividends has averaged about 4.4%. We're living longer. Things are changing. So the rules, you keep the guidelines, but you have to be current and open-minded for the correct solutions.
Well, like the 10-year bonds are paying investment grade. Somebody goes, "No, I saw 4% bonds." Yes, there are 4% investment grade 10-year bonds, but there were people with bad credit.
That's right.
They go, no, it's a high yield bond. That's a person with a company with bad credit.
High yield equals junk bonds in the old days?
Right.
Renaming it, maybe?
Yeah, junk doesn't sell, but high yield sells.
Sounds
of course
good.
I want high yield.
Oh, I'll take one of those, yeah, for sure.
But what we do, I had 2 people refer me business this week. One was a prospect, one was a customer. And I said, the only thing before you refer anybody, you have to know. If you're looking for somebody very aggressive, I'm not your guy. Our company is probably not the place for you. We're pretty conservative all the way around, right, guy?
I think
pretty much all the way around.
Not to sidetrack. I talked to a young guy today, 44. His wife was 43. And I won't mention the large group he was with. He said he was in their most aggressive fund for the last 2 years. Had about 114,000 when he started 2 years ago. Most aggressive fund, good years in the market, and now he's got 113.
Yeah. I've seen people have the same thing from 10 years ago.
Yeah.
It is what it is. That's why another reason why you can't pay high fees. Markets average about 4% the last 15 years. Some of these funds out there might have 2 or 3% in hidden fees. Some of these variable annuities might have 4 or 5% in fees. And I'm telling you, folks, if you pay high fees, one side of the table is very happy, smiling. Right. The other side, which is you, is not that great. It's not going to be a good outcome.
Whether the market goes up or down, they're happy, right?
Yeah. Everybody used to be, you put money in bonds. The problem I got now is bonds are very risky. It's not a hedge against stocks anymore. It can go down right with them because interest rates go up, bonds go down. Usually you're going to get a big premium by doing a bond versus a CD. It's not much of a premium anymore. And so the CD doesn't have interest rate risk. The bond does. And so right now, that's like I said, we've got friends in the bond business, and business is terrible because who wants a dang 10-year 1.6% corporate bond? It's just there's not a lot of answers out there. And that's probably one of the main reasons you've seen such a rise in an interest in annuities is because low interest rates, volatile stock market, more people getting to retirement. I was reading a thing in the investment news this week that was interesting. It said financial advisors need to prepare for the coming age wave. The first wave of baby boomers turned 70 this year. We're both baby boomers. The first ones, we're on the younger side.
I think we're the last ones in the group.
Yeah. They turned 70, and it'll be an unprecedented strain on public programs. Social Security, Medicare, increased demand for private services like financial management, senior housing, transportation, health care, personal care. By 2030, which is less than 14 years away, it's only about 13 years and 2 months away, the 65 and older population in the United States will be 50% larger than it is today.
Which I'll be about 70 then. Golly.
And so does that mean you can count on Social Security to be the same?
I know Medicare costs have to go up. They just have
Medicare costs. Social Security will be fixed. I think they said if it just drop benefits about 25%, then it could be fixed. Maybe 30, some other reports, but 20, 30%, it can be fixed. Medicare, it's a lot worse.
Yeah. And I think they're going to have to means test it. My only hope is that before they cut you out, you have to have X amount of dollars, like millions of dollars, and they'll take care of the middle income people that were good savers and maybe have a couple $1 million put away.
Yeah, we have a longevity problem. Benefits more than likely going to be cut. Also, people didn't save enough. Because why? Because life happened. Half of the households, 55 or older, have zero retirement savings. Half of them. This is a 2015 GAO, Government Accountability Office. Zero. The other half, with some savings, the average is $104,000. Well, remember we told you CDs are paying 1%, bonds are paying 2%. You got $100,000. Even if you did the bond, the higher 2%.
$2,000 a year.
About $100 something bucks a month.
Yeah, $2,000 a year.
Yeah, it's nothing.
2%.
Yeah, $150 a month, $160. It's terrible. All right. Even if you did it like an annuity, which gives you higher income, it's only about $300 a month. Only 10% of households have at least $500,000 in savings anymore. And with the interest rates where they are now, and looks like they're going to stay here, the government seems completely unable to raise interest rates. If there's any blip in the market at all, it's not supposed to be connected, by the way. If there's any blip, not going to raise them this time. I know we were talking about it. Not going to be this time. Or they raise them like 1/4%.
Are you saying the government agencies work together?
It sounds like it. You seen those WikiLeaks things?
They will only work together against us. They don't seem to be able to work together when they want to put something through in our benefit. But I've heard a number of people recently talk about the same thing that we've talked about. You've mentioned a lot. And one of the problems with raising the interest rate is what it does to the debt and the liability that our debt has.
I know. Like I said, older people might be okay. The kids, they're screwed, right?
Yeah, but I'm talking about our federal debt.
Right. Well, you've got if Congress does nothing between now and 2034, the entire Social Security trust is exhausted. With the amount of workers and retirees, that balance, but remember that balance is going to change. You're going to have 50% more retirees. They're saying just at today's numbers, you'd have to cut about a 21% across the board cut. And so that's why when you're doing a retirement plan, you're going to have to factor a higher amount because sometimes they're more than likely going to cut Social Security in the future.
Well, no,
they're still going to have it, but they might cut it.
Yeah, well, no, wait a second. They gave the banks how many trillions of dollars to bail them out?
Oh, yeah, but that's not going to happen to us.
They won't bail out Social Security?
No, they like the banks.
That's fair.
The Goldman Sachs. Look how many people work for the government. Used to
Oh,
be
yeah.
Goldman
Sachs runs the Treasury, or did for a long time. Paulson and the whole deal, for sure.
All that we're trying to get to the point is nobody's going to help you with your retirement except you. You have to do a plan that factors in inflation, factors in a possible cut in Social Security, a cut in pensions. Remember, I talked about one of my neighbors here, retired firemen that are getting firemen or policemen. Now I've just forgot. They've been retired for a while.
Yeah.
But their pensions got cut like 30, 40%. And, you've already been retired for years. That's not something you expect. Because remember, your expenses go up over time. The water bill's not going to go down. Your gas bill's not going to go down. The food's not going to go down. But yet I got a 30% cut.
And if you do it now while you've got the most in your accounts before the market corrects, you'll be better off.
That's right. We got a break coming up. Stay with us, folks. Remember, if you'd like any questions answered, like any free information in any of our commercials or shows, don't hesitate to call our hotline, 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. We're back after being off the air for 2 weeks for the UT football games.
Trying to knock the rust off.
Like I said, they personally told me, president of CBS, that would not happen again. I just wanted to let you know that. There's a couple of things. Wealthmanagement.com, there's an interesting article. And it was talking about baby boomers seek security in annuities. What you've got is this pool. You've heard us talk about annuities for years. Some of them can be really helpful. Some of them can be awful. And it takes a real expert to figure out which ones might be helpful or awful, because some companies and some advisors basically just sell what they're told to sell. And fit everybody in the same box.
And think about it. That's not only annuities. That's mutual funds. That's bonds.
Got to sell this managed program. That's the end-all, be-all. Everything in the world revolves around this managed program or this mutual.
Figured it out.
That's right.
Got a mechanical system.
That's right.
It's worked forever.
Think about every single of your biggest Ivy League colleges in the world. They've done thesis papers and studies, research. You wouldn't believe the computer programs they put together to try to figure out the market. Not one of them's ever figured it out, but some broker has something.
How about the Harvard Endowment Fund? How many sharp minds run that?
Some of the smartest people in the world, they've never figured out yet. Some broker selling me something has.
Although they do pretty good, right? Like 9 or 10%, something?
Not that high, but they've done pretty good.
I mean, it's pretty
they're
good,
not
pretty
bad.
strong.
It said the financial crisis challenged investors' faith in the stock market. Equities sharp drop during the crisis, and their up and down ride recently have encouraged investors to be more cautious with their money. Baby boomers especially have reevaluated their approach. Baby boomers are creating a retirement income strategy and looking for peace of mind. And it's the same thing with people who are real wealthy. Somebody asked me, well, you talk to people that are real wealthy and people that are just regular. What's the difference? I said, really wealthy people don't ask you for 20% returns. They tell you, don't lose money.
Yeah.
Whatever you do, don't lose money. And I'm going to think, if it's a retiree, let's say it's a regular person, might have saved between $500,000 to $5 million, and they're retiring. You know the number one thing they should tell me, and they do a lot most of the time, don't run out of money.
Yeah.
No matter what, I do not want to run out of money. I want my expenses to be paid for the rest of my life, no matter what. And it's weird, the advice you get is completely different than that if you go to 5 different advisors.
As a rule of thumb, the less money someone has, the more aggressive they become, because they want to catch up. They want to have twice the money and 3 times the money, and it doesn't work well.
Yeah, here's some more from this one article from wealthmanagement.com. It's more about the baby boomers. 10,000 baby boomers retire every day. The place is likely to continue for 15 years, right? That's where you've got that 50% increase in the next 13, 14 years
right.
of retirees. And the main thing is they want enough money to retire. The baby boomers have to retire early. A lot of them have to retire earlier than planned because of health problems, layoffs. The one thing that, it's not the old days where you get the big pension, you get the gold watch, you get a big party. It's they're, laying your butt off when you're 60-something years old and you want to retire, work for 4 or 5 more years, and you get nothing.
Wow.
Just, by the way, here you go. And good luck if you're 62 years old getting a job, Because what happens is the bigger companies, they've already moved out the older people to pay younger people less. And the little companies, healthcare has gotten such a ridiculous cost. If you've got a 10-man office, you put one 60-year-old in there, you could double their healthcare or make it go way up.
We've got a friend, no names, but corporate attorney here in town for a large corporation. He brought in a couple younger guys, trained them, thought they were going to be his assistants and his help. Once they got the whole thing down, they let him go.
That's like whenever you get bought out or something like that, you're usually training your replacement. You just didn't know it, right? But the number one thing boomers want, according to this article, a dependable income stream. A dependable income stream. How much income can you get? I see so many advisors out there say, well, you could just do it with dividends. You could do it with this. Is that a dependable life income stream? Dividends have gone down for 20-something years.
Yeah, not anymore.
Interest rates have gone down for 20-something years. I have no idea what they're going to be. So now they're, the average dividend on the S&P is like 1 point something. Of course, you can buy higher dividend stocks, but they're going to crash like the market does. Now, they may crash a little less because they're not mostly growth stocks.
Right.
When you're a mature company, you're not trying to grow as much. That's why you put out a lot of dividends and things like that. And a lot of them are also utility companies. And even though they should, they don't. If the market goes down, they're still going to charge you the same for your electricity. And they're probably still going to raise it.
It comes down to the old adage. If you want it done right, you need to do it yourself. If you can find the right vehicle, we certainly can help you. But if you are looking, look for the right vehicle that'll take care of, we say it over and over again, your hard expenses, something that'll provide that income for you, something that'll be guaranteed, something that's an absolute, not a maybe, not a could be. If the market does this, you'll be fine. But take care of yourself. You need to do it.
Yeah, and that's why our retirement analyzer and stress test is so valuable. Remember, there's no cost or obligation for it. But what you do is it puts in inflation, all those things. It can put in, all right, I want to do a dividend-producing portfolio. What does my life look 5 years into retirement,
Absolutely.
10 years, 20 years? Even if you're 10 years from retirement, you still got to plan for this kind of stuff. Because if you can plan 5 or 10 years before you actually retire, you can make changes for pennies on the dollar. It's going to cost you that much more when you actually retire. A lot of people say, I just don't want to mess with anything. I'm too busy. I'm telling you, if you can do it a little bit earlier, it's pennies on the dollar for the changes. The changes are much more painful when you get into retirement. And so you need to know these things. I want to put in, let's say you want to put in some managed program, whatever you want to put in there, an annuity, whatever you want to put in there, it'll tell you what your worst case is, what your best case is, what your average case. But remember, if you can plan for the worst and hope for the best, that's what really works. You can't have the market paying your bills. It won't work. It never has. If you'd like to take advantage of that, no obligation, no cost retirement plan, call us at 972-715-2424, or you can go to ilovemyretirement.com. We got a break coming up, folks. Stay with us. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. One of the things that we've talked about, one of the most frustrating things being a financial advisor for 30 years now is sometimes when you'll do a financial plan or retirement plan for someone, and they really need more income than a dividend's going to pay, or a CD is going to pay, or a bond's going to pay, and so you might recommend an annuity. Just said you can do the non-annuity option,
Right.
Or you can do the annuity option. The annuity option will pay you this much more income. What's the get? You're going to give back something. You could use principal if the market doesn't, make it back. But it's guaranteed the rest of your life. Even if the money runs out, you can never run out of money. Also gives you double your amount for long-term care. If a nurse comes to your house, they double your income. Those are nice benefits. And then invariably you'll have, well, my broker said that's a terrible idea. Annuities are for suckers. And I said, well, they have to say that. In other words, if it was a great idea, they should have came up with it, right?
Well, it used to be they would say that all the time. That was the default answer. But then
not anymore. Now I've got you one.
Right,
I got one you should
that's
do.
exactly right. Well, let me find one for
Like
you.
what we do, we're independent advisors. We look at all of them. There's 144 of them out there.
That's right.
Your big offices, big companies, I'm trying not to mention names.
You caught yourself.
They
That's
offer
good.
1 to 3. Is the most I've ever seen is 3.
Yeah.
We offer, if there's 144, we offer 144.
And if there's a new one that comes out that's A-rated
Oh, yeah.
and has a better offering, we'll offer that.
Right. And so it used to always be they're terrible. But the one thing is, I had somebody come in the office this week. Well, my friends told me, and their broker said annuities are bad. So you'll hear that from brokers. You'll hear it from somebody with an agenda. Everybody that does both, you don't hear it anymore. Independent advisor, you don't hear it anymore.
And no group can be an expert in everything. At Dillon Gage, we are experts with the fixed annuity. We've been doing those since 95. We're expert with the managed money. We use ETFs, and we've got an expert bond department. So there's 3 areas that we are very strong in.
What people don't know is you always got to look at where the advice is coming from. If it's coming from someone with a competing product, then it's biased information.
Absolutely.
Mutual fund companies, Ken Fisher.
There it is.
I mean, he says, why I hate annuities, you should too. Greatest marketing campaign in history.
Because he doesn't make any money.
Doubled or tripled his assets under management 3 or 4 years after being in business 40.
But look
Greatest marketing deal.
Look at all the money he spends advertising.
But all
it's
it is
everywhere.
You don't need to do that because you need to do my managed program.
Exactly.
That's the devil's work. This is the holy grail. It's just another product.
Exactly.
But if you look deeply, get away from the advertisement that as soon as you click on one, it follows you around. No matter what search you got this why I hate annuities thing on the side of every search engine. You look at Wharton professors, MIT, Harvard, Yale, all of the academics out there, they're coming with a completely different story.
And we've got the articles if you're interested.
That's right. We're talking about people that said have analyzed with the longevity of people, with the losing of pensions, with the volatility of the stock market. Almost all of them reached the same conclusion that we've been touting on this radio for 20 years.
And I think we did it first before that.
Way, of course.
And I don't know if Ken Fisher's got the Nobel Prize in economics like some of these professors.
Oh, yeah.
Just saying.
Maybe they'll give us the Nobel Prize
Oh, that'd be
since
nice.
we were first.
Bob Dylan just got it.
Stole our information.
We could. That's right.
But that is the truth. It's coming to now because it's a different world now. And that's why I wanted to talk about, one of my clients is a CPA. And they said, it's amazing that everything you've been saying on the radio and you've told me in person here, did you have this person on the payroll? I go, what do you mean? They said the continuing education course basically said everything you've been saying, that you need to do this, this, and this. And it said, a good idea would be annuity. And you've told me that forever, and I said, I have nothing to do with it. If the more you research, the more you actually forget biases, take away any kind of bias, it is hard not to come to the same conclusion. Now, if I could get 5% CDs, 8% CDs,
you would.
The world is different now. I'd rather have a CD, 10% bonds. Yep. I'd rather have that. If the stock market was less volatile, it wasn't overvalued, worse than it was in 2007 before it crashed in 2008, that's a different story. If we didn't have 6 negative earnings quarter growth in a row, that'd be a different story.
I get it. But I got to tell you, these old school CPAs, and there's nothing wrong with them. We all use them, and we love them for what they do. But they cram for these courses, and they get their recertification. And what do? They go back to their old school ways because that's the way they are. It's hard you're a product of your environment. It's hard to change. We talked earlier in the show, things are fluid. Things are changing. We're living longer. Lots of things are changing, and the products are changing.
Yeah, no, you don't have to change. Let's say you've got $1 million and you can live on a 1% CD.
Or two.
$10,000 a year in income. Then you don't have to do anything. I know somebody goes, well, I don't care about 1%. I've got $50 million and I'll only spend $2,000 a month. I go, well, congratulations.
Yeah.
You're happy. You want to adopt me?
You've won the race.
That's right. You don't need to do a thing. But for the rest of us, you have to really listen to this stuff. We can send you the articles. We can do whatever you want. Remember, call us at 972-715-2424. When we get back, we're going to briefly go over this continuing education for CPA course, and then we'll answer some questions or so. Remember, call us at 972-715-2424 or go to ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. We've been talking about today just retirement things and all that. We're talking about a little bit about annuities. The world has changed. Everything has changed in the last 15, 20 years. things that we didn't think were going to be anything to do with, who'd have thought health insurance had got ridiculous like it is?
Oh,
Who'd have thought, remember I was complaining about my $600 water bill? There's no way I could have fathomed that 20 years ago. And that's the same kind of stuff that we have now. That's why you have to plan for these unexpected things. We talked earlier about them having to cut Social Security possibly 20-something% across the board just to keep it solvent. And that's with today's number of retirees. But we also said on the other side, it's supposed to be 50% more retirees in the next 13 years. And so those are big things that you have to account for. So you have to have a retirement plan that's going to do all of these things. All right, because if you cut it too close, believe me, retirement can be miserable or it can be great. If I know I've got $10,000 a month in bills and $20,000 a month coming into my bank account every month, that sounds like a pretty good retirement. Now, you don't have to go that drastic, obviously. But if you've got 10,000 bills, or whether it's 2,000 or 1,000, and you got 10,500 coming in, retirement's not going to be that great.
no, and sometimes we've talked about it. Call us. We can go in great detail if you'd like. But there's some programs out there that will increase. Your payments will increase over time. If the market goes up 3 or 4%, your payment goes up 3 or 4%, and that becomes your new floor. In other words, it can't go lower. And then the market may not do anything for a year or two, and then the next time it increases, we get a portion of that, and our pension increases. So there's some neat solutions.
Remember, it's all math. It's just math.
Exactly.
The one thing people don't do, opinions, blah, blah, blah. You got $1 million. CD's paying 1%, pay you $10,000 a year. A 10-year bond, investment grade bond's going to pay you like $20,000 a year.
You got $1 million. How about taking half of that? Maybe, and I don't know the circumstances. Right. I'm just saying, how about taking 500,000 of that, deferring it for 5 to 10 years, getting payments as if it was $1 million, still having your other 500,000 growing in your investment accounts, and it's not shouldering the burden of you having to withdraw from.
So you said $10,000-$20,000 a year. The reason why annuities are popular is not because of commission, it's not because of fees, because managed money pays more over time than any of them.
Period.
That's a sales pitch. The real reason is I can't live on $10,000-$20,000 a year on $1 million. What about $60,000 to $100,000 a year on the same $1 million? I'm not saying put it all in there, but maybe I could put half as much and get more income on half.
That's right. And still have the cash.
That's right. And so that's what a lot of people do. Is it's got to make sense. It's got to say, all right, how do I get the most income? Don't concentrate on the growth once you're retired. Concentrate on the income. People do the same exact thing. I know people, especially they manage their own money. Don't worry, Victor, I'm doing the exact same thing I've done for the last 30 years, and it's been very successful. Make one mistake in retirement, it's over. Think about it. I got people all the time that go, I've got $2,465 coming to Social Security, and I've planned well. I only have $2,300 in expenses. And I'm like, remember, Social Security gets cut, means tested.
Yeah.
Anything happens, then you got inflation. Because remember, just 4% inflation, your expenses double every 20 years. What everybody puts in there, it's you get 50% less purchasing power or something like that. Well, that confuses people sometimes. Your expenses doubled. You got $4,000 a month. It will be $8,000.
I'll give you a real good example. My first new car, I think I bought in 1980, and it was a Plymouth.
You're old.
Yeah, it was a Plymouth Sapporo, I think was the model. But anyway, I paid like $12,000 for it. But I remember looking at the $24,000 car, which was their top of the line, baddest thing with leather. There's no way I could afford that. Now today, $24,000 is your basic car.
No, we lived in Preston Hollow when I was a kid. My dad drove in a brand new red Lincoln with the vinyl top, vinyl top on it.
Landau
right?
top.
Oh, it had the big seats in it. And I was like, wow, Dad, how much did that cost? He goes, $7,000.
Which was a lot of money.
Can you believe he actually had $7,000 to buy a car?
This is like early 70s.
It was a long time ago.
Yeah.
That's when I was a kid.
Yeah.
But those kind of things will change. You've got to plan. So that's what I was looking at. Remember a client of mine's a CPA, and they going through a continuing education course. And they said, did you write this thing? I mean, I go, no, I've never heard of it. But it's called the New Rules of Retirement. This is a continuing education course for CPAs. Remember, it used to be annuities bad. Now everybody's doing them except somebody selling something competing.
Bonds
when you go to the academics, they're all saying, hey, With interest rates where they are, volatility in the stock market, you got to look at this stuff.
But you can get bad advice. A lot of, again, the old school people still remember the way they were taught and they were brought up, but things have changed.
Yeah, here's that continue. I took some excerpts from the continuing education, the CPA continuing education course I thought were interesting. It says, this is the stuff we've been telling you for years. Life expectancy, and therefore the length of retirement steadily increasing. Employers and governments continue to reduce benefits to older Americans, leaving retirees more and more on their own. Higher income older Americans receiving less support as the government programs become means tested. Income and estate tax laws changing significantly, requiring updates to the plan. We've had a decade, the last couple of decades have been real different. It said the most important lesson for more than a decade is retirement has changed and will change again. You need to expect change. Your plans, your retirement plans need to be flexible. And are you ready to adapt and adjust them? Yes, you need a retirement plan. And that's what we've been telling you. I don't care if you're 45, 55, 75. You need a written retirement plan to show you actually what happens and do scenarios on it.
Where you're going to be.
Yeah, what if Social Security's cut this much? What if inflation goes this much? All of these different things. What if your dividends you're getting cut down some? We can do all that for you. Call us at 972-715-2424. Again, 972-715-2424. You can go to ilovemyretirement.com. We got a break coming up, folks. Stay with us. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. What we talked about is what we've been given. Remember, we've been doing managing stocks, managing bonds, managing annuities for 30 years.
We've taken companies public.
That's right. And it used to be where you had the stock crowd. They were old Wall Street, blah, blah, blah. Annuities are horrible.
We make money the old-fashioned way.
Right.
We
The annuity guys were lower. Now, all these companies, pretty much every company out there does annuities now. I don't know one that doesn't, except for selling a exclusive and competing like a management product.
Got it.
They only do that, and they think that fits everything. But it's just like saying that an annuity fits everybody. That's ridiculous.
Well, and their pitch is that they can adjust quick enough.
That's right.
To get in and out
Our
of the sector.
experience is going to do this.
Whatever.
We got a mechanical program that does. Nothing fits everybody. And that's why you've got to
Even
run your
annuities.
finances through a program to
Right.
see, all right, what are the potential holes? How do we fix this stuff? And then plug in different scenarios, or different investment options, different investment strategies, and see how they work for you and your family.
How many of your clients, Victor, that I know mine are the same way, have you put all of their money into the managed program or all of their money into bonds or all of their money into annuities? Do you have any client that you've got all of their money into one category?
No.
Absolutely not.
All right. Remember, this is the continuing education course for CPAs. It said new help for retirement. Perhaps the most important change in retirement planning the last decade is the fresh focus of professionals and academics. Remember I said it used to be, oh, they're terrible. Now all the academics are going the other direction. No, you need to do it. It said when I first prepared the first edition of this book, few financial professionals or academics addressed the issues of Americans in or nearing retirement. They were still concerned with helping younger people maximize the accumulation of wealth, though they largely neglected the needs of those who are past the accumulation phase of life and we're in the post-career spending or decumulation, stage of life. Most of those who did offer advice to retirees relied often on rule of thumbs. In other words, you can take out 2% a year, 4% a year, whatever.
We talk about that rough math.
Intuition shortcuts to make recommendations. They're basically trying to fit you in the same mold when, remember, the distribution phase of your life is nothing, financially I'm talking about, nothing like the accumulation phase of your life. It says, a related change is the new focus on strategies for generating reliable income streams and cash flow in retirement. Till a few years ago, almost all investment research was geared towards maximizing long-term returns. And that's what I try to tell people. If you want the best long-term returns, if you're okay with risk, the stock market is the place. If you want the most income, nothing will pay you more than an annuity.
And if you've got the most income and you've gone through a plan and you've got your income needs taken care of plus some, then you can do long-term growth with the other part of it and leave it for your heirs. They enhance your stock portfolio by allowing you not to have to touch it.
we're talking about the new rules to retirement, the CPA, continuing education course. It said that they're interested in making wealth last. They're talking about how people have changed over the last couple decades, keeping it safe and generating reliable income to ensure they can pay their expenses for an indefinite period of time. Remember, you got to worry about it. People didn't used to live that long. At the turn of the century, the average age was like 40-something. So when they invented Social Security, what do you think the life expectancy was? You know what it is, guy. What was it when they invented Social Security?
62?
65.
65.
They figured, well, most of these people are going to be dead. Let's start it at 65. But that's what it was. Let's see. Oh, here's the new holy grail of investing. Keep my money safe and pay me income. Everything has changed. It's not because people are making commissions versus fees. It has very little to do with it. It really has to do with we have no interest rates. And the government doesn't care about savers or retirees, doesn't give a flip. What they do care about, keeping the economy moving. What keeps the economy moving? Low interest rates. People keep buying and selling houses. What happens when their home values go up? They feel richer. What do you do when you feel richer?
Spend money.
Spend money. That's a chug of the economy. Let's say I'm a business owner. I'm a business owner. So what do? I can expand my business. I can get a loan to expand my business because the interest rates are lower. So if anybody thinks the government is all of a sudden going to change, because even with 6 negative earnings growth quarters in a row, the market hadn't crashed. These zero interest rates
it's crazy.
Helped the market for a long time, right?
Oh, yeah.
If you think they're going to change, you're crazy. They're going to keep interest rates low probably for the rest of our life. The only time they went up, remember the late 70s, early 80s? It was like 78 to about 81.
Oh, yeah. Carter.
They didn't do anything. They said, let those interest rates run. I go, because high interest rates are healthy. Something it'll cool off a rising economy, right? Going too fast.
Purges and yep.
But now since then they've controlled them, and they said, hey, we don't have to worry about it because those high interest rates hurt the economy for a decade. Right? And they're not going to do that again. So you got to deal with what we have now, and that's why even CPAs, all the academics are saying now, you better start thinking about annuities because everything's different. They're talking about people, Austin used to retire. Now some people are working part-time into retirement. They're retiring later. 20 years ago, nobody heard about retiring at 70, 75.
That's true.
Now it's commonplace. Average retirement age, which was actually the late 50s to 60. Now its average retirement age is 70. There's how many people in our office right here are over 70? There's a few of them.
4 or 5.
Around, there's probably 10 that are around that. That's how many people it happens to. And it talks about here in this new thing, it talks about avoiding debt and all that kind of stuff. But it just supports what we've been telling you here for years on this show. You have to keep your open mind. You have to look at every kind of option, and that's what our retirement planning software will do for you. Call us at 972-715-2424. Again, 972-715-2424, or go to our website, ilovemyretirement.com. I'm Victor McClure. For Guy Allert, we always appreciate your time.
The preceding show was paid for by the Dillon Gage Wealth Management Companies and Victor McClure and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice